Welcome to Industrial Alliance Investment Management's April's macroeconomic and market update. On discussion today is our investment team's takes on major market movers of the past quarter and our outlook for the rest of 2022. My name is Rose Marcello, and I'm a client portfolio manager at IEIM. Joining me for this conversation is Jean-René Adam, Principal Vice President, North American and Quantitative Equities. Jean-René heads the public equity team at IEIM. Thank you, Jean-René, for being here today. We've seen a lot of volatility in financial markets since the beginning of the year. Conversations have centered around inflation shock, monetary policy normalization, sector rotation, recession risk. What are the specific impacts on equity markets?
Yeah, it's a good question. I think it's fair to say that 2022 will be a more challenging year. And the reason is mainly aggressive tightening by central banks because of high inflation. Monetary policy is having an effect on investors' risk behavior. Just think about, following the pandemic, central banks, decreased interest rate materially, printed money, and you saw risky asset that did very well in that environment. Multiple expansion for equity. So obviously, it doesn't just work one way; it works both ways. Having said that, I think there are many reasons to invest in the stock markets currently. I think there's a lot of nice opportunities, but you got to be more thoughtful than you were the last 2 years when almost everything was going up. So the first thing to notice is that the stock market is forward-looking. So all the central bank being, very vocal about tightening, I think it's been really included in the stock market in the first quarter, and that's why we saw the correction. So, we can assume that a lot of that tightening is already priced in. The other thing is that with the correction we've seen in stock market, stocks are cheaper and more attractively valued than at the beginning of the year. Something that we notice also is a change in market leadership. So remember, over the last 10 years, growth stocks outperform almost every year value stock. And so we see exactly the opposite in the first quarter. Value stock were pretty strong. So this is something we think will continue. We think the market environment with, being late in the economic cycle, higher interest rates, higher inflation should continue to favor value stocks. Talking about inflation, a nice way using the stock market to protect ourselves from inflation is to have a portfolio of dividend growth stocks. And the rationale is pretty obvious. When you have inflation that's going higher, you're losing some purchasing power. And so having a portfolio where the dividend are growing also nicely, it helps you offset that inflation. And what's good about dividend growth is that usually it follow year of strong earnings growth. And so 2021 earnings growth were fantastic. So you can expect very strong dividend growth this year. And you can see that with the left chart here. So for the S&P 500, the number of dividend increases this year is very important. So the data that you see for 2022 are year to date, but annualized for the whole year. And so the right chart is showing you, the dividend per share for the S&P TSX. So the black line here is telling you that dividend per share should increase materially. And we're talking about probably close to 10% dividend growth for both years for the US and Canada.
Great, that's good to know. Well, if we move on to the geopolitical context and the very risk factors that you're foreseeing, your team and you seem to think that Canadian equity could benefit from the situation. Could you share your rationale with us?
Yeah, for sure. So I do feel that most of the macro trends that we're seeing today are favoring Canada. So let's start with inflation. So I already discussed dividend growth portfolio, but one of the best investment to protect yourself from inflation is commodities. And so as you can see on the chart here, the left chart here, there's almost 30% of the S&P TSX index that's composed of commodities. So 16% is energy, so oil, natural gas. 13% is commodities. So think about copper, gold, fertilizer. So that should react well in an inflationary environment. And something else that I would add is that I think supply and demand for commodities is expected to be tight in the coming years. We've seen demand that came back strongly with strong economic growth and supply that don't really react because companies have underinvested for the last 10 years in new projects and new mines because commodity prices were lower. Even if they would start today and they're doing it, it takes a long time before you see an effect on supply. On top of it, there's also the war between Ukraine and Russia that kind of add to the commodity price increases. Obviously, as you can see on the right chart, so Russia is one of the largest provider of commodities. And so, with the sanction that we've seen and the risk of supply disruption, there's kind of a nice increase in prices that we've seen. And I think that even if the war would go away, I don't think, first, it doesn't mean that sanction will go away. And second, I think that that risk premium there's a big part that will stay in the price of commodities because now, people are worried about Russia. Another trend helping Canada is higher interest rate. So the best sector to invest in the higher interest rate environment are the financials. And as you've seen in the previous chart for the TSX composition, so 32% of Canada, of the S&P TSX is financial. And so, a big part of it are banks. So banks obviously are making more money with their lending when interest rates are increasing. And they also need kind of a steepening of the yield curve that we think could come back later this year. And maybe a last point in Canada is the fact that Canada is, I alluded to the fact that value is doing better than growth. It should continue. Canada, by its nature and it's the way it's composed, the TSX, it's more value than growthy. So another thing that should favor Canada. And it worked pretty well in 2022 so far. We've seen, in the first quarter, and this is corrected all over the world between 5 and 15%, whereas Canada was up almost 4%. So a meaningful outperformance. So in conclusion, I guess that, yeah, 2022 is going to be a more challenging year for sure. But I think there are nice opportunities in the stock market. However, I think that to navigate that environment, you really need to have a good portfolio manager this year.
Great. Thanks. Thanks for that insight. Well, thank you, gentlemen, for your time.
Thank you.